One thing I want to drive home today is the KISS principle. Keep it simple, stupid. Fancy gets broken. If you're high income, high net worth, avoid the traps that allowed you to get wealthy in the first place. So I want you to keep it simple. Don't step over dollars to pick up pennies.
Welcome to the Military Money Manual podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Hello and welcome to another episode of the Military Money Manual podcast. I'm your host, Spencer, here with my co-host, Jamie, and today we're talking about advanced personal finance topics for military families, military service members. Now, a lot of you are not going to be able to relate to a lot of the topics we talk about today, but I still think it can be valuable just to plant the seeds of things to think about as you increase in rank, as you increase in pay. Maybe if you get married and you have a spouse that works, you have a partner that works, you could find yourself in a situation very rapidly, which you might not be familiar with, which is a high income situation. And it's even in the military, which a lot of people don't consider what we do to be high pay, especially on the officer side. It can get very high paying very quickly if we're talking about people who receive language bonuses or pilot bonuses or even pay for different specialties. You can very quickly get yourself into, a top 25% of income earners in the country.
Okay, so there's really three categories that we're going to talk about today. We kind of bunch a couple topics into three categories that are taxes, wealth protection, and investment fees. And if you're not at the point yet where you're worried about these topics yet, at least use it as education for you, for your future self, or share it with a friend who's maybe a little bit further along in their journey. It'll at least give you the knowledge to understand what people say when they use some of these terms.
Yeah, kind of the person that we're targeting with this episode is usually a dual couple. And it could be dual income captains or dual officers approaching like that 04 pay grade. And if you look at the pay charts for dual 04s, you could pretty quickly push 250,000, maybe even 300,000, depending on what your BAH is. And a lot of that is tax-free. So if you converted it to civilian pay, it would be even higher because in order to have an equivalent pay grade or pay amount, you'd have to compensate for the taxes. But luckily in the military, we don't have to worry about taxes so much. But that being said, as your pay increases, you will have to start worrying about taxes. And for a lot of high income individuals, taxes are their largest expense every year, which is pretty crazy to think about. Not a problem that you have when you're at the lower ranks, whether it's enlisted or officer. One thing I want to drive home today is the KISS principle. Keep it simple, stupid. Fancy gets broken. So I want you to keep it simple. Don't step over dollars to pick up pennies. It doesn't help having a super advanced Backdoor Roth IRA strategy like we're going to talk about in a couple minutes if your TSP is 100% invested in the G fund. You have to have an appropriate asset allocation. You have to take care of the basic hygiene functions of personal finance before you move on to the advanced tactics that we're going to talk about in the next couple of minutes here. So don't ignore your 5% TSP match if you're under the BRS. If you're paying state income taxes and you're stationed in a state that doesn't have income tax and you intend to reside in that state upon departing active duty, then switch your state of legal residence to that state. It blows my mind that people will pay state income taxes for decades to a state that they have no intention of returning to when they leave active duty. We'll start off with the first topic here, and that's the Backdoor Roth IRA. And this fits under the taxes category. And again, those three topics that Jamie brought up, taxes, wealth protection, and investment fees, those are kind of the three things that I think really move the needle for any high income individual, but for military service members as well. If you are high income, if let's say you're two doctors, or if you're a pilot married to a doctor, then the things that are going to have a big impact on your financial success, whatever it may be, are probably going to come down to how well you manage your tax burden, how good you protect your wealth, and how low you can keep your investment fees. And anything beyond that is really beyond your control. And then one more thing I want to say before we jump into our topics here is, if this is too advanced for you, it's okay to put up your hand and ask for help. The Military Financial Advisors Association, MFAA, we had one of them on the podcast recently, and they're all certified financial planners, CFPs, or studying to become CFPs. And they've all either served or been military spouses. And so if you're not comfortable doing it yourself, DIYing these tactics, it's okay to reach out to a CFP and get some help. And in fact, if you are making over $200,000 a year and a CFP is going to come alongside you and charge you maybe $1,500, $2,000 a year to help you make smart decisions, that's going to save you tens of thousands or possibly even hundreds of thousands of dollars over your investing lifetime, that's a great investment. So as a huge advocate of DIY setup, I think DIY personal finance is the right answer for probably 90% of people early in their career, because A, you can't really make that big of mistakes, and B, it's not hard. It can be hard, but it's simple. Throw money into your TSP. It's have an emergency fund. It's the Dave Ramsey baby steps. It's stuff that we talk about in almost every episode that really only takes, I don't know, Jamie, maybe 4 or 5 hours of time to kind of read through. I mean, you could read the Military Money Manual in a couple hours.
One afternoon.
Yeah. And then go and apply the principles in a couple hours a week for the rest of your life, and you'll do fine. You'll probably end up a millionaire at retirement. But for these advanced things, it's okay if you reach out and want to get a little help. So Jamie, Backdoor Roth IRA. People might have heard about this before. What is it? Who's it for? And let's talk about the Backdoor Roth IRA.
Yeah, so this is advanced because it only affects people with a higher income. So a backdoor Roth IRA is a conversion that allows higher earners to open a Roth IRA despite IRS imposed income limits. So if you're not eligible for the Roth IRA contributions due to your higher income, you can convert your contributions at a time of your choosing, pay the taxes on it at that time, and then the money can grow tax-free and be taken out tax-free at retirement as if it were regular Roth contributions before you had high income, for example. So you can choose, let's say you deployed for 6 or 12 months, so you have a lot of tax-free, very low income for the year, then maybe that's a time to look at conversions. But the backdoor Roth allows you to basically contribute to a traditional, and then at the time of your choosing, you can convert it to Roth. You have a tax bill for that, but you're then able to let it grow tax-free. So only post-tax dollars go into your Roth IRA. So if you deducted your traditional IRA contributions and then to decide to convert your traditional IRA to a backdoor Roth, you'll need to give that tax deduction back. And so that's why there's a tax bill with it. You're not eligible for Roth IRA when you're single. Your modified adjusted gross income, you'll see that abbreviated as MAGI. In 2024, the number is $161,000. So if you're single over $161,000, you're not eligible for a Roth IRA, or at least the tax credit. There's an even more advanced topics that we won't even mention right now, but $161,000 if you're single to be eligible for a Roth IRA. And basically, if you're curious what your modified adjusted gross income is, it's your adjusted gross income, your AGI, with additional deductions. And if you look at your past tax returns or ask your CPA, you should be able to see that, or they can give that to you very, very quickly. If you're married, your MAGI over $240,000 in 2024 would make you ineligible for Roth IRA. So Roth IRA for married, you have to be making an modified adjusted gross income of $240,000 or less. And then there's tiers in there. You can look it up on Google. If it's above that, it's a reduced limit allowed. So pay attention to that. But if you're anywhere close to those numbers, you probably need to do some research and start looking at it. But there's no income limits on the Roth TSP, which is important for our service members to understand, or any 401k or 403b like employer-sponsored plan. So even if you're a 4-star general and you're making a ton of money, you can still contribute to a Roth TSP in the employer-sponsored plan. So to summarize, this is basically you choosing to move your traditional IRA contributions to a Roth. So you take the tax hit now, if you choose to take it now, and then let it grow tax-free for the rest of your investment life.
Yeah. And the reason you'd want to do that, not just contribute to a traditional IRA, is because a traditional IRA also has income phase-out limits. So for 2024, if you have a modified adjusted gross income, or MAGI, of $240,000 or more, and you're married filing jointly with a spouse participating in a retirement plan at work, there's a whole bunch of caveats here. This is why people hate the U.S. tax code. but you're not allowed to take a deduction at that point.
This is what I said we weren't going to mention. Non-deductible IRA gets complicated, but no, it's important to say probably. You're right.
Well, it's because you're making a non-deductible contribution to a traditional IRA. You might as well just move it over to a Roth IRA, pay the taxes on it today. But the reason that you can't make the contribution straight to the Roth IRA is because they have these income limits. But for some reason, Congress authorized this loophole. I think it was maybe back in 2015 or something. It was a couple of years ago, and it was the way the tax code was written, and people were doing it. And then a couple of years ago, I think it was in the Tax Cut and Job Act 2020, 2021, somewhere around there. But they've officially blessed it, and they said, yes, this is U.S. tax policy that you can do this backdoor Roth IRA.
Yeah, a lot of people are like, oh, that sounds shady. It is 100% legit, and everyone knows about it. You can ask any CFP. I've never met a tax professional or a financial planning professional that has been like, ooh, that's super shady. You shouldn't do that, or you risk an audit. So there's no worry about being shady on this. So backdoor Roth, pretty good one.
Yeah. And if you Google like how to do a backdoor Roth IRA, Fidelity, Schwab, there's some blogger out there who will have taken screenshots and will walk you through exactly how to do it. And again, like the big brokerage firms, they have it set up so that you can do these backdoor Roth contributions automatically through their website just with a couple clicks. So Vanguard has a really nice setup. So what I do for my backdoor Roth IRA these days is like the first week of January, I'll make the full contribution to my traditional IRA. I'll just stick it in a money market fund so it doesn't grow very fast. It's only going to be in there for a couple days anyways. And then once the money's in there and Vanguard acknowledges that I've made the contribution, then it's just a couple clicks, on the little three dots. And I say, convert to a Roth IRA. It says how much you want to convert. I want to convert the whole amount. Because the one gotcha here is you can't have any money in an IRA or including SEP IRA, or else it gets taxed at a pro rata rate. Again, all these terms are super complex and demonstrate that if you're not comfortable, if you're not hanging out with us right now, go talk to a CFP about this because you don't want to get it wrong. Although I will say after the first time you do it, it's pretty basic after that because usually you're going to empty out your traditional IRA accounts so that you can execute the backdoor without incurring any kind of taxes.
There's a lot of things there. There's also, depending on when you contributed the money, you might actually be taking out money from 5 years ago or things like that. So it can get complicated real quick. And that's why if you're actually using any of these, it's probably one of those triggers where you should probably be paying for help. Another one where I definitely think you probably want help and someone on your team is looking at capital gains and loss harvesting. So Spencer, just generically, like what is capital gains and capital loss? Can you explain that before we get into how we harvest them?
Yeah. So as most basic, you made money off an investment. So let's say that, it could be on the gain side. If you bought a stock for $100 and 2 years later, it's now worth $200 and you go to sell it, you've made a $100 capital gain because you bought it for $100 and you sold it for $200. And because it was over a year long, so if any sale under a year is a short-term capital gain and it's taxed at the regular income tax rate, which is much higher than the long-term capital gains rate. And the reason the government has done that is because they want to incentivize long-term investment, which makes sense. So for most people in the military, high income military service members, anytime that you sell an asset, and there's lots of exemptions for houses. So a lot of people get caught up on this in real estate, but there's lots of, I think is it $250,000 of capital gains that you can deduct on a real estate sale? I'll have to look that one up to get the specifics on that. But let's say in 1 year that you had a S&P 500 fund and it was down 20%, but you made a lot of income from your job. This is tax planning, tax strategizing. In November, December, you might want to go talk to your CPA and say, look, I have this fund and it's down a lot. If I sell it, I'll be able to, what they call is capture a capital loss. And essentially what that is, let's say you paid $200 for a stock and now 2 years later, it's worth $100 and you go to sell it. Well, you have a $100 capital loss. That can be advantageous because you can use capital losses to reduce your taxable income on that year's tax return when you go to file. So it's up to a limit though. I think is it $3,000?
Yeah, $3,000. And you can carry some of it over And that's an example of how it gets kind of complicated. So like, for example, right now, I started looking at my tax numbers for 2023. I'm carrying a capital loss from 2021, even though I also did the $3,000 capital loss offset. I forget the proper term, offset from last year. So I'm doing it again, even though it's from a couple years ago. And there's a limit there. I forget if it's 7 years or whatever, but you can roll it over several times potentially. But like Spencer was saying, this is good. Let's say that you used to be big into individual stock and you happen to get lucky with like a Tesla or a Meta or Alphabet or whatever, Google. So you have individual stock because it used to be your strategy. And now we've convinced you that you're too solidified in one company and you want to diversify a little bit. Well, it goes down. Let's say you're at a loss for the stock anyway, and you sell that and then you have a capital loss that you can harvest. Or if it's up, definitely if it's up, say you stand to make 20 or 50,000 or more off of the sell of that share, then you probably want to talk to your tax professional or CPA, a CFP type, about when to sell. Maybe you do it anyway right now, but maybe there's something to do where, hey, your income's kind of high this year. Maybe you wait to January to do it if it's close to the end of the year. There'll be all kinds of factors that they look at. We'll talk more about charitable donations later, but maybe you do sell it and you offset it with more charitable giving this year and some of the strategies that they'll get into. There's also a bunch of rebuy rules, so it gets kind of complicated. You can't always buy it again the next day without some restrictions. So again, this is one you're going to want some help. You're going to have to do more research on, but just know that there's a strategy out there for harvesting capital gains and harvesting capital loss, and understand that there's short-term capital gains and long-term capital gains that are taxed at different rates.
So the next topic we'll talk about is the donor advised fund, or DAF. So a donor advised fund is a really interesting way to reduce your taxes and also support the charity organizations, the 501c3 charitable organizations that you support anyways. So what a donor advised fund allows you to do is you can donate cash at its most simple, and then you can make donations from the DAF to the organization that you want to support. But even more interestingly is you can donate appreciated stock or mutual funds or ETFs to the donor advised fund. And what that allows you to do when you donate appreciated stock or shares is you can skip paying the capital gains on those shares. So I think it's only for long-term capital gains though. I'll have to double check that one. I don't think it works on short-term capital gains. But what that allows you to do is, again, let's say that 10 years ago, you bought some Apple shares and today you're sitting pretty and your Apple shares went from $1,000 to $10,000 and you got $9,000 of capital gains there. And you're like, dang it, that's going to be a $900 tax bill because I'm in the 10% long-term capital gains bracket based on my income, rather than paying the $900 to Uncle Sam. So let's say, in one scenario, you could sell the stock, right? Then you'd have $10,000 minus the $900 of capital gains tax, so you have $9,100. And then you went and donated that to your DAF or to the organization of your choice, and they would have $9,100. Alternatively, what you could do is just donate the shares to your DAF, skip paying the capital gains tax, and now your DAF has the full $10,000, and then you can distribute that to the organization of your choice.
It can be a little confusing if you've never heard of a donor advised fund, but the fund itself is a charitable donation. So when you donate to like the Vanguard DAF, or I use a fintech app called Daffy, D-A-F-Y, I forget if there's two F's in there or not, but I think it's D-A-F-Y. And so when I send 5,000, 20,000, 25,000, whatever you do, that is a charitable donation for that year. And then you recommend to the charitable donation that I now want to give to this church or this synagogue or this youth program or this whatever community charity. So you're still doing it directly, but through a charity that then can contribute to other charities. So that's where the benefit is that the DAF itself is a charitable donation.
And you can do that. So let's say that like in 1 year, you had really high income and you wanted to make a big charitable donation to your DAF, or you want to make a big charitable donation and capture all the tax deduction that you can in that year, but you don't want to contribute all the money to an organization straight away, you can put it into your DAF. So let's say that you support your church to the tune of $10,000 a year, and you were going to make $100,000 donation this year because you had a really great year. Rather than giving your church $100,000 right away, you might want to put it into your DAF and then have it go to your church over the next 10 years. And the other thing you can do with donor advised funds, which I think is really cool, is you can invest the money that's in there into Vanguard, like total stock market fund. You can invest it into CDs, into treasuries, basically anything that the administrator of the donor advised fund allows you to invest in, you're allowed to invest in. And so the money that goes in there can grow and eventually become self-sustaining. So let's say that there's a scholarship that you want to support and it's, $2,000 a year and for your football players who want to go to the academy from your high school, right? Well, you can set it up 4% rule, 2,000 times 5. Yeah. Okay, you're going to need $50,000 in there, and you could put $50,000 in there, and now you have a self-perpetuating fund that'll just go on, forever. And you can even have your beneficiaries, so say your children, inherit the control of the DAF, and so when you die, they'll be able to keep it going. The interesting thing in there is because it's already been donated to a charitable organization, they have no access to it. So they might be really excited to say, oh, we've got this fund here with $100,000, and then a little disappointed to realize, oh, I don't get to spend any of it. But hopefully you've raised them and explained to them, this is something that we enjoy doing, and we hope that you can continue doing it, and you pass that tradition of philanthropy and charity down to the next generation.
Spencer, this brings up another good topic when we talk about donations called donation batching. And so what I really like about this as an advanced topic to consider is that instead of donating $100 a month or $5,000 a year, you maybe bunch it where 2 years of donations get piled into 1 year. And then you are more likely to be able to itemize your taxes and actually take advantage of something that's above the standard deduction. Since the Tax and Job Cut Act or the Secure Act, I forget what changed it a couple years ago, the number of Americans that itemize now is less than 12%. So a lot of people think like their donations to Goodwill are helping their taxes, and they're really not for most Americans anymore because so many of us are taking the standard deduction. Well, if you're a high income earner or an advanced personal finance user, at some point, you might want to look at the strategy of donation batching to get a really high deduction for the year. Maybe you take the standard deduction 1 year and then the next year you itemize, and you can use the donor advised fund, park the money, invest it, and you'll get growth. Like Spencer mentioned, the 4% rule, you take a little bit of it out to donate each year directly to a different charity, and then it'll continue to grow. So you can donation batch, pile your donations into 1 year is a strategy that some people will use on a more advanced level.
The standard deduction is in 2024 is now up to $29,200. So that's a pretty high hurdle. Even for a high income couple, that's a pretty high hurdle to jump. But you might find yourself lucky enough to be in a situation where you can be donating $30,000 to your donor advised fund and you get to itemize your deduction. It's not going to save you too much because it's only $800 over the standard deduction, but at least the money's going to an organization that you choose and not an organization that Congress chooses.
On top of that, then you add the Goodwills and the other donations on top of it, and maybe there'll be actually something there.
Yeah, and before we move on, Jamie, you mentioned Daffy. It's DAFFY, and I haven't personally used them, but I know that you've had really great success with them, and I've been using Vanguard Charitable, which I find super easy to use because I can just go into my Vanguard account and I can donate appreciated shares very easily to my Vanguard Charitable DAF. The one thing I will mention is Vanguard recently had this little pop-up and said, hey, do you want to use min tax to calculate the tax that you'll owe when you go to sell shares? And I said, sure, that sounds great. So I selected that. And then I went and donated shares to my donor advised fund, and it applied the min tax rules. And so it chose the least appreciated shares to donate to my DAF, which was exactly the opposite I want to do. If you're going to donate shares to a DAF, you want to donate your oldest and most appreciated shares so that you're not on the hook for those capital gains tax. So that was a little DIY versus hiring some professional help. I'm sure if I had had a CFP, they would have reminded me like, hey, make sure you double check your tax lots, but it's okay. I'll donate some more this year and make up for it.
Just a quick note from one of our sponsors, and then we'll be right back to the show.
It's no secret Spencer and I are both huge fans of the Thrift Saving Plan, the military's version of the 401k retirement plan. We've both been investing in the TSP for over 14 years and are thrilled to announce we've consolidated all the information you need to know into a new course called the Confident TSP Investing Course.
That's right. The course is a comprehensive guide to navigating the TSP, breaking it down to easy, bite-sized chunks that lay out the basics of the thrift savings plan, the funds available, and the investing strategies so you can build wealth while you serve.
We both know what it's like to be a beginner and to be overwhelmed with all the information that's out there about investing in the TSP. Head over to militarymoneymanual.com/TSP, Tango Sierra Papa, to find our simple breakdown of all you need to know. You get lifetime access, and we'll have a growing library of content. And one of my favorite parts about the course is that for every course we sell, we're going to be donating one to an E4 or below.
Yeah, I love that feature of the course, Jamie. So if you're an officer, an NCO, a senior NCO out there, and you purchase a course, first of all, thank you. And also know that you're helping a fellow service member, a sailor, a soldier, a Marine, an airman, a guardian, a Coast Guardsman, E4 or below, take one step closer to their financial success.
And until the end of 2024, you can use promo code podcast24 for $20 off. The link's in the show notes, or head over to militarymoneymanual.com/TSP and use promo code podcast24, where you can sign up for the Confident TSP Investing Course. Now, back to the show.
Next, Jamie, we're going to talk about Roth conversions. So this is different than the Backdoor Roth IRA, Roth 401k. Military service members don't really have to worry about Backdoor Roth 401ks because the TSP, the Thrift Savings Plan, the Roth TSP, does not allow for backdoor contributions. But let's say that you were a active duty pilot married to a civilian doctor and she was making good doctor money, then maybe check out whitecoatinvestor.com. Great resource there for all medical professionals. But that's an instance where maybe a civilian provider does allow a backdoor Roth 401k. Roth conversions, on the other hand, this is moving traditional IRA money out of your account and converting it to a Roth IRA account. It's very similar to the backdoor Roth IRA, but usually when people talk about executing a backdoor Roth IRA, they've already emptied out their traditional IRA account because they don't want to get hit with that pro rata tax rule. And so they have a zero balance, $0 traditional IRA account, and they're just contributing money for a couple days, and then it's moving right into the Roth IRA account, and it barely sits in the traditional IRA for more than a week. The Roth conversion is, so I'll take my personal example here, Jamie. That with the Roth conversion, I was able to contribute money to my traditional IRA when I wasn't deploying as much. And so I was able to reduce my tax burden. Let's say it was like 2015. I would contributed $6,000 or whatever the contribution limit was to my traditional IRA. So I reduced my tax burden by $6,000. I was able to deduct on my taxable income. Then when I deployed for a full year in 2018, so I was tax-free the entire year, my income dropped to like $10,000, let's say. None of my military income was taxed and only my secondary income sources were taxed, like my side businesses. And so in that year, I had extremely low taxable income. And so what I was able to do was convert my traditional IRA to a Roth IRA. I just did it up to the standard deduction limit and I paid no taxes on the conversion. I think actually I did go a little bit above the standard deduction limit just because I wanted to clear it out so I could start doing backdoor Roth IRAs. But that's a very advanced strategy, a Roth conversion, traditional IRA to Roth conversion. I've got an article on my website about this. If you Google like traditional IRA to Roth conversion military, that should come up in any of the search engines or AI bots that are about to change everything. It's great if you're deployed or some people take career intermission program and their income might drop while they're going back to school or something. So there's an opportunity there to get some of your money out of your traditional account that you already got to take the deduction on, move it into a Roth account. And once it's in the Roth account and it's been there for 5 years, all of it's considered a contribution. And you can start pulling it out without paying any penalty or taxes on it because it's considered a contribution at that point.
Yeah, so this is another example of something to look at if your income changes, whether it's a deployment for a year or say that your spouse was a high income earner and one of the partners takes a year or two off work to raise the baby or something like that. So your taxable income is way down compared to what it used to be. Roth conversions is another good one to look at. All right, next up, we're going to start talking about protecting your assets, which is just as important probably as growing your assets. You want to make sure that you still have something left at the end of the day. And so on that one, the big topic here that we're going to talk about today for protection is umbrella insurance. So we've heard about auto insurance, we've heard about renter's insurance and homeowners, but what on earth is umbrella insurance?
Yeah, so umbrella insurance is basically personal liability insurance that goes above and beyond your homeowners or renters and auto insurance. So as you probably know, America is pretty litigious.
We sue a lot.
We sue people a lot, yes. And one of the ways to protect yourself from that is to have umbrella insurance. So let's say that, there's always like some examples of it, but it's like, somebody comes, like kids come over and they're playing in your pool and one of them drowns. I mean, that is like absolutely horrible. The last thing you're probably thinking about at that moment is money, but the parents might sue you, and it does happen. And what is the life of a child worth? I mean, that's a horrible question to ask, but yeah, it's a question that might come up in court. And if you have substantial assets and the judgment goes against you, you might be on the hook for a couple $1 million of damages. Other instances are like, multi-car crashes. Say you hit some black ice, you end up on the other side of the highway and, 5 people slam into you and every car has 4 people in it. Like before it's $100,000 of damage per car or per person. It gets very expensive very quickly. And if you have substantial assets, then the court might decide that you need to make restitution to the people that you harmed. And maybe it's through no fault of your own. So all that being said, umbrella insurance is insurance on top of your liability insurance for your homeowners, for your auto insurance. Usually those limits go up to 500,000, sometimes up to $1 million. And the umbrella insurance comes up on top of that. So usually the recommendation that I've seen is insure up to your net worth. So if you are lucky enough to be a millionaire and you've crossed the 7 figures mark, then you should have $1 million umbrella insurance policy. And what most insurers are going to require is that you hold your renters or homeowners insurance with them and your auto policy with them, and they're maxed out. So you are $500,000 of personal liability, $500,000 of medical liability, of basically every category of liability. And so this is interesting because you could have, let's say you drive a beater car, right? And you're like, I'm not getting comprehensive insurance. If this thing explodes tomorrow, I'm just going to go buy myself a new car. That's fine. They're more worried about the liability. So if you've maxed out your homeowners, your renters liability and your auto policy liability insurance, then the insurance company will offer you an umbrella insurance policy that will come over top of all those insurance policies. And the nice thing about umbrella insurance, though, is it's actually really cheap for how much coverage it provides. So I've seen usually the first $1 million is like $200 to $300, but every subsequent $1 million is only like $100 to $50 to $100 usually
a year.
A year, exactly. Yeah. So you could have $5 million of coverage and pay less than $600 a year. There's probably somebody out there listening to this right now. They're like $5 million of net worth. They're out there. I mean, there are absolutely military service members out there right now. Maybe not $5 million in net worth, but probably pretty close.
It's possible.
Yeah, it's definitely possible. You'd be surprised. Read The Millionaire Next Door. Like, there's a lot of money out there. And not only that, but there's probably a lot of veterans out there that after they leave active duty service, they go get a higher paying job, and pretty soon their net worth climbs very rapidly. So take a look at umbrella insurance. I would say, Jamie, if not something to worry about if you're under 7 figures, if you haven't quite cracked that $1 million net worth yet. And I would say that's probably liquid net worth. So, if your house is worth $500,000 and your mortgage is $400,000, then that's $100,000 of net worth right there. That's not $500,000 of net worth.
Cool. All right. Before we get into the third bucket we mentioned, this one doesn't really fit anywhere. So let's go ahead and talk about giving gifts a little bit right now. And then we'll get into investment fees and a couple of recommendations at the end. So giving gifts could be for a donation or not, like as far as a charitable donation or not. But as your net worth grows, a more advanced thing is to be incredibly generous. And anyone that knows, like the Dave Ramsey baby steps Spencer mentioned earlier, that baby step 7 of live and give generously, could be cash, could be jewelry, could be appreciated stock. But a lot of people are scared of what that means to your taxes. So I just want to run through that quickly and let you know that if you are blessed and have the ability to be generous, like it's not cosmic. Right now in 2024, the annual gift limit to not pay taxes on it for the recipient or the giver is $18,000 per person. So my spouse and I could each give $18,000 or $36,000 a year total to an individual without any tax bill. So that is pretty powerful. And that could definitely be a life-changing amount of money if you're in the situation to give that type of money. There's also a lifetime limit if you want to give more than $18,000 per person this year. That doesn't mean that once you go over $18,000, you're going to immediately owe taxes. It just means you're going to have to file a gift tax return. But as long as you're under the lifetime limit, which is a lot of millions, I'll talk about that in a second, you're likely not going to owe taxes on it. So if the gift exceeds $18,000 limit for 2024, the IRS allows you to give away up to $13.61 million in assets right now. And there's rumors this number might come down, but even if it goes down to $7 million, let's say, that's still a lot of money. I doubt any of our listeners are giving away that much money. And if you are, please let us know. You'll come be a guest and let us know how to accumulate that kind of wealth while serving in the military. But so up to $13.61 million in assets or property over the course of the lifetime and or as part of the estate. So if a gift exceeds that annual exclusion limit, the difference is simply subtracted from the remainder of the lifetime exemption limit and no taxes are still owed. You just have to report it to the IRS, like you said, with the IRS gift tax return, which is separate from what you do with mill tax or through your CPA, just a different form that they can help you with. You report it using a form 709, and it basically deducts this year's overage from the lifetime exemption, like I said. And a person's lifetime exemption limit applies to gifts that a person gives while still alive and property left to heirs after the person's death. So you're talking about giving more than $18,000 a year and leaving them over $13 million before taxes are really an issue here. So don't be afraid of it if you're in this situation. To summarize, you can be generous, just keep good records. And if you're above 18, you do a little extra paperwork, no big deal.
Yeah, this is a great one, especially I don't think we have many older listeners out there, but if you happen to have a parent or grandparent who's in the situation where, they're getting close to the end of their life and they want to, give away some money, this is an easy win for everybody because it's a gift. It's not taxable. So if they want to start whittling down on their the nest egg that they've accumulated, $18,000 a year, that's a great chunk of change. Let's say you got 10 grandkids, there you go. You can give away $180,000 a year. And for a lot of elderly who are collecting RMDs, required minimum distributions from their IRAs, there's income coming in that they literally cannot spend. And it's just going right back into a taxable brokerage account, and it just keeps growing, and they're going to leave millions to their heirs. But imagine if you could give, a gift to a family member or a loved one today that allows them to make a memory, go on vacation, pay for school, get a better car, make that repair on their car that they've been putting off for a long time, pay off their student loans. There's so many, I would struggle to name a person that I know personally that would not find a good use for $10,000.
Yeah. It could be, as like you mentioned, a car, like there's a college student, a niece, nephew, cousin, someone that's struggling, like change their life and give them a $15,000 car. If you're in the situation to do that, that could be really powerful. And it sets an incredible example for them as they build their financial footing. Maybe you have a cousin or a sibling or someone who's struggling, and maybe you cover their mortgage for 2 or 3 months. $1,600 mortgage payment for 3 months, 4 months, whatever. Like that makes a big deal to them. But if you're still listening to this episode, it probably is not that big of a deal for you. And maybe that's something that you and your partner talk about, you and your spouse talk about, of what are we going to do when we are accumulating so much money and we want to be generous with it? Like what even would that look like for us? And then you can use that as motivation to keep going and building instead of just thinking about getting stupid rich.
Yeah, that's a great segue, Jamie, to the book Die with Zero, which addresses many of the topics that we just talked about, giving away money, living your best life, realizing that for a lot of very successful, very wealthy people, there's going to come a point where you've basically out-earned your lifestyle. You're not going to either have enough health or have enough time or just have enough energy, to spend your accumulated assets. And unfortunately, for those of us who are good at making money and investing, there's no prize, getting the highest score. He who dies with the most toys doesn't win. You're still dead. So enjoy it while you're here and use it to better the world and to better your loved ones and leave the world better than when you found it, I think is one of the operative things to do there. But one thing we didn't really talk about in kind of the 6 topics that we just covered, Backdoor Roth IRA, capital gains, loss and harvesting, donor advised fund, Roth conversions, umbrella insurance, giving gifts. We didn't cover investment fees, but I think that gets back to kind of the keep it simple, stupid. If the core of your investment portfolio is not in low cost index funds, go read the Military Money Manual, go read The Simple Path to Wealth. This is your opportunity to not mess this up because, that 1% fee that you were paying an advisor when you had $1,000 or $10,000, like it doesn't mean a lot. It doesn't add up a lot. But when you start talking about 1% of $1 million, that's $10,000 a year. What are they doing for that $10,000? And you could hire a lot of CFPs to do a lot of work for you. So they better be justifying charging that 1% fee. And I've found that most of them can't.
And they can't beat the average returns most of the time either.
There's this great report that the S&P puts out every year where they look at active funds versus passive funds. And the longer you stay invested, the less likely you are to be in an active fund that can beat a passive index.
They might beat it 1 year or 2 years, but they're not going to beat it in 100 years, over 100 years consistently. The other thing with investment fees is a lot of people are talking about how I can get a 0.02 or 0.03 with Fidelity or a free fund with Fidelity, and the TSP is more expensive than that. When we talk about investment fees, those aren't really going to move the needle when we're talking about like a 0.03 to 0.05. It's the 0.05 or the 5 basis points up to like a 1% or 1.5. Those are where you have to be careful with, not those really small nuance changes. Don't move your whole fund from Vanguard or Fidelity to save 0.01%. It's not going to move the needle.
Yeah, exactly. A couple of books I want to recommend for high income, high net worth listeners that we might have. And if you want to talk more about the topic, reach out to me because I am interested in it. I am thinking about maybe starting a new side business and just having conversations with high net worth and high income individuals, especially with a military service background. But Die with Zero, we mentioned it before. We've mentioned it on probably half our podcast. Love that book. Great book. Really recalibrated my personal thinking on what am I doing all this for. The Almanac of Naval Ravikant, I think, is another great kind of philosophical book. Introduces a lot of concepts about the value of work, the value of time, the value of health. And he's an interesting guy, smart guy, venture capital guy, invested in Uber and all the other kind of billion-dollar unicorns. And then 4,000 Weeks, another great book on the shortness of life, the brevity of life, and how we only get 4,000 weeks, so we got to make the best of it. If you find yourself starting from a middle class or low income upbringing, and now you find yourself, this is the classic social mobility story that we love to talk about in America, where you can have a poor kid from Alabama and he goes to the Air Force Academy and becomes a pilot. And 10 years later, they're flying for Delta. And 10 years after that, they're making, $500,000 a year. If you find yourself in kind of that story where you started out poor and now you're making more money than your parents ever made, James Grubman wrote Strangers in Paradise, How Families Adapt to Wealth Across Generations. It kind of help you think through the transition from one socioeconomic class to another. And then the last one I'll mention is From Strength to Strength. That's Arthur C. Brooks. And it's basically, as you get older, we're not quite as clever as we used to be. And so we need to transition a little bit in what we're good at. And I think you might find yourself in that situation as your income increases and as your net worth increases. And then just to close it off, you've got a fantastic opportunity here. If you're high income, high net worth, don't waste it. And don't fall into the trap that so many people do of they get rich once and they want to get rich even richer, or they want to accelerate the path to whatever number they think is going to make them happy. It gets back to that, keep it simple, stupid. Avoid the traps that allowed you to get wealthy in the first place. So anybody who's on TikTok talking about generational wealth, skip it. Index universal life insurance, skip it. Infinite banking, skip it. Whole versus term life insurance. Term life is going to work for 99.9% of people. I mean, every single millionaire that I know, not a one of them became a millionaire because they invested in whole life insurance. Not a one. And then unfortunately for W-2 employees out there aren't a lot of tax breaks. So anybody who's telling you, oh, go buy a Tesla and, whatever. I mean, there used to be an EV credit, but I think that's gone away now for the Teslas. So there's not a lot of tax breaks, unfortunately. So you have to utilize the ones that you have access to, which include traditional 401k, backdoor Roth IRAs, giving, donor advised funds. So use the tax breaks that are available to you and don't overthink it and don't search for a magic bullet. It sucks, but if you're paying taxes, you're making money. So congratulations.
Spencer, I'm just going to add 2 other things to the list of things to watch out for or to avoid. Watch out for emotional decisions, because for some of you, you may have never seen money like this in your entire life. So it may be overwhelming, or you may get excited, or the first time you see your investment account go down by 6 figures, like we've talked about before, don't let that change your philosophy. Just be prepared for that. And that's where sometimes paying for help can be worthwhile as well. And then the last one I'll add is don't be overweighted in any one area. So you might now have $1 million and you're like, hey, I'm going to put $1 million in real estate because then I'm going to 2x it or 5x it. Just be careful. Stick with your investment philosophy. Be smart about it. Keep a diversified portfolio, like Spencer says in his book, low cost, automatic, diversified, and simple. Don't take your nest egg that you've now accumulated and think you have to have this ultra complex thing in order to make it grow. You're probably going to have enough. If you're working on these topics, like you're going to be fine. So don't go overboard on it. We hope that these topics today on advanced personal finance topics for military service members and their families are helpful for you. If you're still with us and they're not helpful for you, hopefully you at least learn something as well. And we understand that for a lot of our audience, these are going to be way above where you're at right now, and that's okay. Hopefully you learned at least a definition or what it means when you hear people talk about it. If it did add value, please shoot us a note on Instagram at Military Money Manual or via email at podcast@militarymoneymanual.com. And we specifically ask for what other advanced topics do you care about? Because we could do lots of series on this, but we understand that most of our listeners, especially the new ones, are at the beginner level. So we'd appreciate feedback on that, as well as any reviews or sharing with your friends, whether it's on Apple or Spotify, wherever you listen to the podcast. Come back next week. We are putting out a very good lineup over the next couple months. We're very excited for our next few episodes. We got a lot of great guests lined up this spring. As we prepare for a busy summer, we're trying to get ahead. So thanks for joining us each week, and we really appreciate you guys.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.